In October of last year, buried inside a routine mining press release out of Canada, there was a single clause that sent shockwaves through every procurement department on the planet. Samsung, not a mining company, not a bullion bank, not a hedge fund, Samsung, one of the largest technology conglomerates in human history, paid $7 million to a small Canadian mining firm called Silver Storm Mining to restart a dormant silver mine in Mexico called La Parrilla. But the money was not the story. The clause was. It read, Samsung obtains the exclusive right to purchase 100% of the mine, is silver and lead concentrate output for the next 2 years. Let that register. Samsung did not go to the commodity exchange. They did not buy futures contracts. They did not bid in the spot market. They went directly to the source, the rock in the ground, and locked it up before a single ounce could reach anyone else. That is not normal procurement. That is a war footing. And Samsung is not alone. Tesla has reportedly launched an internal initiative called Project Redwood, a strategic program to secure its own silver supply chain independent of public exchanges. Every electric vehicle rolling off a Tesla production line contains between 25 and 50 grams of silver in its power, electronics, and sensors. Samsung's own new EV battery patent requires a full kilogram of silver per vehicle. At current production scales, these companies are consuming silver faster than the planet can dig it out of the ground. Meanwhile, NVIDIA's AI chips, the engines powering the artificial intelligence revolution, depend on silver-based conductive pastes and components, where silver accounts for up to 60% of production costs. SK Hynix has already declared its entire 2026 high-bandwidth memory output sold out. Every data center, every AI server rack, every next-generation semiconductor, silver is embedded in all of it. Here is the question that should be keeping you awake. These are the most sophisticated supply chain operations on Earth. They have teams of analysts whose sole job is to forecast material availability 5, 10, 15 years into the future. When Samsung bypasses the global exchange system and locks up an entire mine, they are not making a speculative bet. They are acting on information. They are telling you, through their actions, that the silver supply chain is about to break, and they are making sure they are not the ones left empty-handed. The question is, what do they know that you do not? The answer begins in China. On January 1st, 2026, Beijing did something that fundamentally fractured the global silver market. China reclassified silver from an ordinary export commodity to a strategic resource, the same designation as they applied to rare earth elements a decade ago. Under the new rules, only 44 companies received government authorization to export silver over the next 2 years. Every other exporter was shut out. To understand the magnitude of this, you need one number. China exported over 4,000 tons of refined silver in the first 11 months of 2025, representing roughly 60 to 70% of all refined silver traded globally. In a single regulatory stroke, Beijing installed a government gatekeeper over the majority of the world's refined silver supply. And they did not do this quietly. They did it on January 1st, a date chosen for maximum structural impact, the moment when new annual contracts and supply agreements take effect across every industrial sector on Earth. The immediate consequence was a price explosion. Silver, which had been climbing steadily through 2025, rocketed above $90 an ounce in early January and eventually smashed through $100 for the first time in history, peaking near $120 before a violent correction brought it back to the low 80s, where it sits today, still nearly triple its price from 12 months ago. If this investigation is opening your eyes to dynamics the mainstream completely ignores, subscribe and hit like. Because the layer we are about to uncover is the one that changes how you think about every piece of technology in your life. But the price chart only tells half the story. The real crisis is what happened underneath the price. In Shanghai, physical silver premiums surged to $8 per ounce above the Western exchange price. In Dubai, dealers were quoting physical metal at levels that made the official spot price look like a fiction. In Japan, buyers lined up outside bullion dealers. In India, the shockwave was catastrophic. 44 silver trading firms in Rajkot declared insolvency almost overnight, with combined liabilities of approximately $425 million. These were traders who had shorted silver, betting prices would stabilize. China's export controls obliterated that bet. The global silver market did not just get more expensive, it split in two. A paper price set by Western futures exchanges, and a physical price set by the reality of who actually has the metal. The gap between those two prices is where the real story lives. Here's the detail that transforms this from a commodity story into a civilizational problem. Silver is not like gold. Gold is hoarded. When a central bank buys gold, it sits in a vault, unchanged for decades. When you buy a gold necklace, it can be melted down and recovered. Gold above ground stays above ground. Silver is consumed. When silver goes into a solar panel, it is embedded in the photovoltaic cell, functionally irrecoverable. When it goes into an EV battery, a semiconductor, a medical device, a Tomahawk missile, it is gone. The recovery cost from industrial applications runs between $150 and $200 per ounce, often exceeding the commodity price itself. Every year, the world permanently destroys more silver than it mines. And here is where the math becomes terrifying. The Silver Institute has documented that global silver demand has exceeded supply for 5 consecutive years. The projected deficit for 2026 approaches 200 million ounces. But this is not a deficit that price alone can fix, because 70 to 80% of all newly mined silver is not produced by dedicated silver mines. It is a byproduct, a secondary output of copper, zinc, lead, and gold mining operations. You cannot simply decide to mine more silver. You would need to open more copper mines, more zinc mines, more lead mines, projects that take 7 to 10 years from discovery to first production. The silver supply chain does not have a throttle. It has inertia. Now layer on the demand side. Solar energy alone consumed over 200 million ounces in 2025, and every single photovoltaic cell requires 111 milligrams of silver. The solar industry is not shrinking. It is accelerating globally, particularly in China. And here's the cruel irony. The newer, more efficient panel technologies, TOPCon and heterojunction cells, actually use more silver per watt, not less. The weighted average silver intensity is projected to increase from 13.5 milligrams per watt to over 15 milligrams by 2030. The industry is moving in the wrong direction. For solar panel manufacturers, silver now accounts for 29% of total production costs. 2 years ago, the figure was 4%. First Solar, one of the largest panel makers on Earth, is watching its margins evaporate in real time. The break-even point, where solar manufacturing becomes unprofitable, sits somewhere between $100 and $150 per ounce. Silver already touched that range in January. The substitution argument, the idea that copper can simply replace silver, collapses under scrutiny. Industry engineers estimate a minimum of 3 to 4 years to qualify copper paste alternatives, retool factories, retrain workers, and recertify products. Samsung is not waiting 3 years. Tesla is not waiting 3 years. They're locking up physical silver right now, today, because they have done the math. And the math says waiting is not an option. So here's the picture when you pull all of these threads together. China has cut off 60 to 70% of global refined silver exports. Industrial demand is accelerating into a supply that physically cannot respond. The world's largest technology companies are abandoning public exchanges and going directly to mines. The paper price has become increasingly disconnected from the price you actually pay for a physical bar of silver. That disconnection is not a glitch. It is a symptom of a system breaking. On January 1st, 2026, Western futures exchanges quoted silver at $72 per ounce. Physical bullion dealers in Japan and the UAE were selling at $130, an 80% premium for real metal over the official paper price. That has never happened before in modern commodity markets. Gold occasionally sees 5 to 10% premiums during supply crunches. 80% is not a premium. It is a confession that the quoted price is no longer real. The CME Group operates the exchange where the world's silver futures are traded. They responded not by addressing the supply crisis, but by raising margin requirements by 47%. They forced leveraged traders to either post vastly more capital or liquidate their positions. The result was a cascading sell-off that briefly cut the price nearly in half. But here's what the price crash masked. Physical demand did not decline. It accelerated. Buyers in China, India, and the Middle East used the lower paper price as a buying opportunity, draining even more physical metal from exchange warehouses. Here's the question I want you to genuinely sit with. If the world's most powerful technology companies are securing silver through private mine deals, and if the paper price can be moved 40% in a week by changing margin rules, what does that tell you about the reliability of the price you see on your screen? And more importantly, what does it tell you about the future availability of the metal itself? I want your honest analysis in the comments, because this is the conversation that mainstream financial media refuses to have. Elon Musk himself publicly criticized China's silver export restrictions on X, calling attention to the supply constraints threatening multiple industries simultaneously. When the CEO of the world's most valuable automaker is publicly flagging a raw material shortage, the signal could not be louder. Let me bring this full circle. We started with a single clause in a mining contract, Samsung quietly locking up 100% of a silver mine as output for 2 years. That clause, on its own, might look like routine corporate procurement. But when you place it in context, China's export weaponization, 5 consecutive years of supply deficits, industrial demand that is physically impossible to substitute on any reasonable timeline, a paper pricing system that has lost contact with physical reality, and the quiet panic buying from the most sophisticated supply chain operators on Earth. That clause is not procurement. It is a survival strategy. The silver market is undergoing something that has no modern precedent. It is transitioning from a commodity that happened to be precious into a strategic asset with three simultaneous identities: industrial input, monetary metal, and geopolitical weapon. China understood this first. Samsung understood it second. Tesla, NVIDIA, and their peers are scrambling to understand it now. The retail investor, the person watching this video, is last in line. That is not an accident. That is by design. In every resource squeeze in history, the institutions secure supply first, the price adjusts second, and the public finds out third. There are things I do not know. I do not know whether silver returns to $100 this quarter or next. I do not know whether China will tighten or loosen its export controls as geopolitical dynamics shift. I do not know the exact timeline on which copper substitution becomes viable at industrial scale. Honest uncertainty is part of this analysis. But here is what the evidence does support. The structural deficit is real and widening. The demand drivers, solar, EVs, AI, defense, are not cyclical. They are secular trends locked in by government policy, corporate investment, and technological necessity across every major economy. And the supply response, constrained by silver's byproduct nature and the decade-long timelines of mine development, cannot catch up. So what is actionable? Pay attention to what the institutions do, not what they say. When Samsung locks up a mine, that is a signal. When central banks buy gold at record pace while silver trades at a 60-to-1 ratio against it, that ratio is telling you something about relative value. When the paper price disconnects from physical premiums by double-digit percentages, the paper price is the one that is wrong. We opened with Samsung going directly to the source, bypassing every exchange, every intermediary, every paper market on Earth to secure physical silver. They did not do this because the market is functioning normally. They did it because they ran the numbers on what happens when it stops. The smartest money in the world is not buying silver on a screen. It is buying silver in the ground. And when the institutions are that far ahead of you, the window to act is not measured in years. It is measured in months. The metal is real. The shortage is real. The question is whether you see it before the price does.